gain taxation. So, this is a chapter overview and objectives section for a chapter on capital gains taxation. It outlines the learning goals for the chapter the readers is expected to learn about. First is identifying and distinguish between ordinary assets and capital assets. This involves understanding the criteria used to classify assets for tax purposes. Ordinary assets are generally those used in a business, while capital assets are all other assets. Second is classification rules. This covers the specific rules and regulations used to categorize assets. Third is memorizing the two types of capital gains subject to tax and their corresponding tax rates and tax bases. This implies there are different tax rates and calculation methods depending on the type of capital gain. Fourth is mastering procedural computations of the 15% and 6% capital gains tax. This indicates the chapter will cover the detailed calculations involved in determining the tax on. 5 is mastering the rules on wash sale and tax-free exchanges. This deals with specific transactions that have special tax implication. 6 is mastering the exceptions to the 6% capital gains tax. This suggests there are specific situations where the standard 6% rate does not apply. 7 is memorizing the documentary stamp tax imposed on the sale of stocks and real properties. This covers an additional tax that may be applicable. So now, let's proceed to classification of taxpayers' properties. This section describes the classification of taxpayer properties into ordinary assets and capital assets. This classification is crucial for tax purposes as different tax rules apply to each category. First is ordinary assets. These are assets used in a business. The text lists several examples. Stock in trade, goods held for sale in the ordinary course of business. Real property held primarily for sale. Land or buildings intended for resale to customers. Real property used in trade or business, subject to depreciation. Assets used in the business that lose value over time. Real property used trade or business. Assets used in the business that are not subject to depreciation. The text defines a business as habitual engagement in a commercial activity involving the regular sale of goods or services for a profit. Non-profit entities are implicitly included. Basically, ordinary assets are assets held for sale, such as inventory. Assets held for use, such as supplies, buildings, property improvements, and equipment. Second is capital assets. These are any assets that are not ordinary assets. The text further breaks down capital assets into personal, non-business, assets of individual taxpayers. This includes assets not related to a business. Business assets of any taxpayers. These include financial assets, cash, receivable, prepaid expenses, and investments. Intangible assets, patents, copyrights, leasehold rights, and franchise rights. In summary, this section provides a clear distinction between ordinary and capital assets, outlining the criteria for classification and providing examples of each type. This classification is fundamental for determining the appropriate tax treatment of assets under the tax code. So now, let's proceed to analysis of properties held by taxpayers. This diagram illustrates the classification of properties held by taxpayers, differentiating between individual and corporate taxpayers. The key takeaway is that asset classification depends not only on the nature of the property itself, but also on how the taxpayer uses it in their business. Individual taxpayers. Personal assets. All personal assets are considered capital assets. These are assets not used in a business context. Business assets. These can be further classified as either ordinary assets or capital assets, depending on their use within the business. Corporate taxpayers. Corporate taxpayers also classify their assets as either ordinary assets or capital assets, based on their within the business. Important note, asset classification is relative. The same asset can be classified differently depending on the taxpayer's business activities. Example is, a domestic stock is an ordinary asset for a securities dealer because they regularly buy and sell stocks, but a capital asset for someone who doesn't deal in securities. A vacant lot is an ordinary asset for a real estate developer, but a capital asset for someone not in the real estate business. So, ang building A1 is a capital asset if used in non-taxable operations, but an ordinary asset if used in a profit-oriented commercial activity. In essence, this diagram and explanation highlights the importance of considering both the assets, nature, and the taxpayer's business activities when determining its tax classification. The classification significantly impacts how the assets is treated for tax purposes. So, now is asset classification rules. This section details the rules for classifying assets as either ordinary assets or capital assets for tax purposes. The classification significantly impact how gain from the sale of these assets are taxed. Key rules. A. Intended use. A property purchase for future business use remains an ordinary asset even if the purpose is later thwarted by circumstances beyond the taxpayer control. Second is discontinuation of use. Discontinuing the active use of a property doesn't change its classification as an ordinary asset. Previously used. Property previously used in trade or business by a taxpayer are considered ordinary assets. So, real estate business. Properties classified as ordinary assets for being used in business by a taxpayer not engaged in the real estate business automatically convert to capital assets if the taxpayer can prove they have been used in that business for more than 2 years before the taxable transactions involving such property. Depreciation. A depreciation asset remains an ordinary asset even if fully depreciated or if depreciation wasn't taken during the ownership period. Exempt corporation. Real properties used by exempt corporation in exempt operations are considered capital assets. So, transferred. The classification of property transferred by sale, barter, exchange, inheritance, donation, or declaration of property dividends depends on whether the accurator used it in business. Involuntary transfer. For real property subject to involuntary transfer, expropriation, foreclosure sale, the involuntary nature of the sale doesn't affect the classification of the real property. Change in business. Changing from the real estate business to non-real estate business doesn't change the classification of ordinary assets previously held. Taxpayer engagements in real estate. Taxpayer engaged in the real estate business include real estate dealers, lessors, and those habitually engaged in real estate business registered with the Housing and Land Use Regulatory Board or the Housing and Urban Development Coordinating Council as dealers or developers or with at least 6 taxable real estate sale transactions in the preceding year. Illustrations. The text includes illustrations demonstrating how these rules apply in various scenarios involving property previously used in business, property accurate for business use, disposable of property, and exempt non-business operations. These examples help clarify the application of the rule in practice. In essence, this section provides a detailed guide to asset classification, emphasizing the importance of considering both assets, nature, and the taxpayer's business activities when determining its tax status. The rules are complex and require careful considerations to ensure accurate tax reporting. So now let's proceed to types of gains on dealing in properties. This text explains the taxation of gains on dealings in properties, specifically focusing on the distinction between ordinary gains and capital gains and their respective tax treatments. Types of gains. Ordinary gain. This arises from the sale, exchange, or other disposition of ordinary assets. These are assets used in a business. Second is capital gain. This arises from the sale, exchange, or other disposition of capital assets. These are assets not used in business. So now, let's proceed to domestic stocks. This text outlines the capital gains tax rules for domestic stocks sold directly to a buyer, including definitions, taxable events, and specific exceptions. Domestic stocks are evidence of ownership or rights to ownership in a domestic corporation. This definition includes various types of stocks, such as first is preferred stocks. These stocks offer certain privileges such as preferential dividends and liquidation rights. They can be either participative, sharing in common stocks dividends, or cumulative, accumulating unpaid dividends. Second is common stocks. These are the most common types of stocks, representing ownership in a corporation and carrying voting rights. Third is stocks rights. These are privileges granted to existing shareholder to purchase additional shares at the discounted price. Fourth is stocks options. These are contracts that grant the holder the right but not the obligations to buy or sell a certain number of shares at the specific price within a set time frame. 5 is stocks warrants. These are similar to stock options but are typically attached to a bond or other security and can be exercised at any time. 6 is unit of participation. These represent ownership in an associate, recreation, or amusement club such as a golf club or polo club.